Silver's biggest move of 2026 may be days away. June 27th is closer than you think. Something is building in the silver market right now that most retail investors are completely ignoring. And I don't mean the usual noise. I don't mean the Reddit chatter or the weekend stack of forums. I mean something structural, something institutional, something that has a specific date attached to it, June 27th. And if you don't understand what happens on that date and why it matters for silver specifically, you may be watching the biggest move of 2026 from the wrong side of the trade. Stay with me, because what I'm about to walk you through in the next 20 minutes changes how you think about silver entirely. Here's what this video is actually about. Silver has been coiling, quietly, under the surface. While mainstream financial media has been obsessing over equity markets and Fed rate cut timelines, a set of conditions has been assembling in the precious metals complex that historically, and I mean historically across multiple cycles, precedes a violent repricing event. And June 27th sits at the center of it. By the end of this video, you're going to understand three things most investors completely miss. First, why the COMEX calendar creates predictable pressure points, and why the end of June is one of the most important ones of the year. Second, what the current macroeconomic backdrop has in common with the setup that preceded silver's historic moves in 2011 and 2020. And third, what the smart institutional money appears to be positioning for right now, and what that means for you. Most people see a sideways silver chart and think nothing is happening. Smart money sees a spring being compressed. Let me show you the spring. Section 1. The date. Why June 27th matters. Let's start with the date, because this is the part almost nobody in the retail space talks about clearly. June 27th, 2026 is the last trading day of the second quarter. Now, why does that matter for silver? Because commodity markets, particularly silver and gold, experience something called end-of-quarter rebalancing pressure. Large institutional funds, pension funds, commodity trading advisors, macro hedge funds, they all have mandated portfolio rebalancing windows tied to quarter-end dates. And when those windows open, enormous amounts of capital rotate, sometimes out of equities and into hard assets, sometimes the reverse. But here's what makes this particular quarter-end different. We are entering June 27th with silver sitting at a macro crossroads that hasn't existed in this combination since 2020. And if you remember what happened to silver in the summer of 2020, you know that crossroads matters. Between July and August of 2020, silver moved from roughly $18 an ounce to nearly $30 in a matter of weeks. That was approximately a 65% move in under 2 months. Now, I'm not telling you that's about to happen again. What I'm telling you is that the structural conditions that created that environment are assembling again, right now, with a catalyst date sitting just days away. Let me walk you through what those conditions actually are. To understand why silver may be days away from its biggest move of 2026, you have to understand the macro architecture surrounding it, and it has 3 layers. Layer 1, the dollar. The US dollar index has been under meaningful pressure through the second quarter of 2026, and that matters enormously for silver because silver is priced in dollars globally. When the dollar weakens, silver becomes cheaper for every buyer outside the United States, which means demand increases, which means price goes up. But this isn't just about currency math. The dollar is weakening for a structural reason. The United States is running a fiscal deficit that is, by any historical standard, extraordinary. The Congressional Budget Office projections show interest payments on U.S. debt consuming an increasingly massive share of federal revenue. And when a government is paying more in interest than it spends on entire departments of its own operations, currency traders begin asking a very uncomfortable question. How does this end? The honest answer, the one that institutional macro traders are pricing into their books right now, is that it ends through some combination of financial repression, yield curve control, or outright currency debasement. All 3 of those outcomes are historically bullish for silver. That's layer 1. Layer 2, industrial demand. Silver is not just a monetary metal, it is an industrial metal. And in 2026, the industrial demand story for silver has become almost impossible to ignore. The solar industry alone is consuming silver at a pace that the market has never seen before. Each solar panel requires silver paste for electrical conductivity. As global solar installation targets have accelerated, driven by energy transition policies across Europe, China, and the United States, the Silver Institute has been tracking a supply deficit in silver that has now persisted for 4 consecutive years. 4 years. When any commodity runs a supply deficit for 4 consecutive years, the inventory buffer that separates the market from a price shock gets thinner and thinner. We are running out of that buffer, and the electric vehicle sector, the artificial intelligence data center build-out, the defense electronics supply chain, all of them consume silver. All of them are growing. None of them are slowing down. That's layer 2. Layer 3, the COMEX paper market. This is the layer most retail investors never look at, and it may be the most important one heading into June 27th. The COMEX is the primary futures exchange where silver price discovery happens in the United States. And on the COMEX, the ratio of paper-silver contracts that represent silver that exists only on paper, to actual physical silver held in registered vaults, has been at historically elevated levels. What that means in plain language is this: there are far more claims on silver than there is actual silver to satisfy those claims. Now, this situation can persist for a long time. It has persisted for years. The reason it persists is that most futures contracts are settled in cash rather than physical delivery. Most traders never actually demand the metal. But at quarter end, something interesting happens. Open interest on expiring contracts gets resolved. Positions get rolled or closed. And if even a small percentage of contract holders decide to stand for physical delivery rather than rolling their position, the math becomes very difficult very fast. June 27th is a settlement pressure point. Section 3. The historical pattern. What cycles are telling us? Let me take you back in time for a moment, because the historical pattern here is striking. In 1979 and 1980, silver ran from approximately $6 to nearly $50 in a compressed time frame. The primary driver was inflation panic combined with institutional buying, the Hunt brothers famously accumulating physical silver as a hedge against dollar debasement. In 2010 and 2011, silver ran from around $18 to nearly $50 again. The driver was post-financial crisis monetary expansion, the Federal Reserve's quantitative easing program flooding the system with new money, and investors rotating into hard assets as a store of value. In 2020, as I mentioned, silver moved 65% in weeks, driven by pandemic-era monetary stimulus that was unprecedented in both scale and speed. Notice the pattern. Every major silver repricing event in modern history has been preceded by the same combination of factors: dollar weakness, elevated monetary supply, industrial or geopolitical stress, and a COMEX positioning setup that was primed for rapid movement. In 2026, we have all 4 of those factors simultaneously. The question is not whether silver will move, the question is when. And right now, the calendar is pointing at a very specific window. Section 4. The Federal Reserve Dimension. Here's where the story gets even more interesting. The Federal Reserve, under its current leadership, is navigating one of the most difficult policy environments in its modern history. Inflation remains structurally stickier than the Fed's models predicted. The labour market, while cooling, has not broken in the way that would typically justify aggressive rate cuts. And yet, the pressure from a federal government carrying a multi-trillion-dollar deficit is immense. Lower rates mean lower interest payments on that debt, and that creates a political and economic incentive for looser monetary policy that is very difficult to resist for very long. Here's why that matters for silver. Real interest rates, the rate you get after subtracting inflation, are the primary competition for precious metals as a store of value. When real rates are high and positive, investors can earn a meaningful return holding cash or short-term bonds. Silver, which pays no yield, looks less attractive. But when real rates are low, 0, or negative, when inflation is eating away at your cash savings faster than your savings account can compensate, suddenly silver looks very different. The math begins pointing toward precious metals as a rational portfolio allocation when the Fed is trapped between high inflation and a government that needs lower borrowing costs. And right now, that trap is exactly where the Fed appears to be sitting. Section 5. What smart money is doing. Let's talk about positioning, because while retail investors look at the silver price chart and see a sideways metal that hasn't done much lately, the institutional positioning data tells a different story. In recent CFTC Commitments of Traders reports, these are the weekly position disclosures that show how large commercial banks, hedge funds, and managed money accounts are positioned in silver futures. There has been a notable accumulation pattern by what the reports classify as managed money accounts. These are sophisticated institutional traders. They do not accumulate positions in a commodity that they believe is going nowhere. Meanwhile, the commercial banks, the entities that typically act as counterweights to speculative positions, have been reducing their net short exposure in silver relative to historical peaks. Now, in commodity markets, when managed money is accumulating and commercial shorts are contracting, that is typically the setup that precedes a significant upward price move. It is not guaranteed, nothing in markets ever is, but the positioning geometry right now is favorable in a way that does not exist most of the time. Section 6. The geopolitical overlay. There is one more layer to this story that I cannot ignore, and that is geopolitics. We are living through a period of extraordinary geopolitical restructuring. The relationship between the United States and its traditional trading partners has become more transactional, more adversarial in certain corridors. Tariff regimes, sanctions, and trade rerouting have created supply chain uncertainty across virtually every industrial commodity. Silver is not immune to this. China, which is simultaneously the world's largest consumer of silver for industrial purposes and a major refiner, has been navigating its own economic pressures in 2026. Any disruption to Chinese industrial demand, upward or downward, sends signals through the silver market rapidly. Additionally, and this is something the mainstream financial media almost never discusses clearly, the de-dollarization trend that has been building quietly among BRICS-aligned nations has a direct implication for precious metals. As those nations reduce their dollar reserves, they have been accumulating gold at a record pace. And where gold goes, silver historically follows, often with more velocity. The geopolitical pressure valve that was holding silver in a compressed range may be closer to opening than most people realize. Section 7. The risk picture, being honest. Now, I want to be honest with you for a moment, because credibility matters more to me than hype. There are real risks to the bullish silver thesis heading into June 27th. If the Federal Reserve surprises markets with more hawkish language than expected, real rates could spike temporarily, applying downward pressure on silver. If the US dollar index reverses and strengthens meaningfully, it will create short-term headwinds for dollar-denominated commodities. And if equity markets experience a sharp sell-off that triggers margin calls across portfolios, precious metals often get sold alongside everything else in the initial wave of forced liquidation, before their safe haven character reasserts itself. These are real scenarios. They are not impossible. But here's the important distinction. If any of those short-term dislocations occur, they typically create buying opportunities in a structurally bullish commodity rather than trend reversals. The 4-year supply deficit doesn't disappear because the Fed says something hawkish. The solar demand curve doesn't reverse because the dollar bounces for a week. The structural case for silver does not require a perfect macro environment. It requires patience and an understanding that the pressure building in this market has a release date that may be sooner than most people think. Section 8. What to watch in the days ahead. So what exactly should you be watching between now and June 27th? 3 specific signals. First, watch the silver to gold ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, during major silver bull markets, this ratio compresses significantly, meaning silver outperforms gold. If you see this ratio starting to move from its current elevated level back toward historical averages, that is a leading indicator of silver gaining momentum. Second, watch COMEX registered silver inventories. These are publicly disclosed daily on the CME Group website. If you see registered inventories declining while open interest in near-month contracts remains elevated, that is the combination that creates physical delivery stress. That is the spring being released. Third, watch the dollar. Specifically, watch the dollar index around any Federal Reserve communication dates or major economic data releases between now and quarter end. A sustained break below key support levels in the DXY historically correlates with strong silver performance. These 3 signals, taken together, give you the most complete picture of what's actually happening beneath the surface of the silver market right now. The question that stays with you. Here's where I want to leave you. We are in a period of history that, decades from now, will likely be studied in economics courses as a textbook example of what happens when the world's reserve currency issuer runs sustained structural deficits, when industrial demand for a monetary metal accelerates beyond available supply, and when the geopolitical architecture that underpinned the post-war global financial order begins to shift. Silver sits at the intersection of all of those forces, and June 27th is closer than you think. The question I want you to sit with is this: not, will silver move? Because if you follow the evidence presented in this video, the structural answer seems increasingly obvious. The question is, when the move happens, will you have already made your decision, or will you still be waiting for permission from the mainstream financial media that was telling you everything was fine? Because by the time the mainstream narrative catches up to the structural reality, the first and most powerful leg of the move is almost always already over. Do your own research. Make your own decisions. Consult a qualified financial advisor before making any investment. But whatever you do, do not ignore what the data is telling you right now. This is your briefing. The rest is up to you. Nothing in this video constitutes financial advice. All content is for educational and informational purposes only. Always conduct your own due diligence and consult a qualified financial professional before making investment decisions.